Modern Investing Techniques, Episode 12, Friday Wrap-Up, April 3rd, 2026, target 13 to 17 minutes, end of the trading week, everyone. Welcome back to Modern Investing Techniques, Episode 12, coming to you on Friday, April 3rd, 2026. I'm Patrick, broadcasting from Vancouver, and this is your no-fluff Friday market wrap-up. We're going to look at exactly how the week played out across the major indices, dig into the stories that actually moved the needle, and most importantly, talk about the practical disciplines that separate investors who compound steadily from those who give back gains through avoidable mistakes. Before we get into any numbers or analysis, the mandatory disclaimer: everything we discuss on this show is strictly for educational and entertainment purposes. The practice investment of the day uses simulated trades with zero real dollars at risk. I am not a licensed financial advisor. This is not financial advice, and nothing here should be taken as a recommendation to buy or sell any security. Always do your own due diligence and consult a qualified professional before putting your own capital to work. Markets involve real risk of loss. Past performance, even simulated, does not predict future results. Let's start with the headline that dominated travel and leisure conversations all month. Norwegian Cruise Line, NCLH, dropped a painful 24% in March. The decline wasn't just about one weak earnings print. It was the combination of disappointing guidance, renewed concerns around geopolitical risk in the Middle East, and lingering fears that any escalation involving Iran could disrupt key cruise routes and passenger sentiment. When you layer on the fact that cruise lines carry high fixed costs and operate with significant debt, even a modest drop in booked occupancy or pricing power can hit margins hard. What struck me most is how quickly external shocks can completely override what looked like reasonable fundamentals only weeks earlier. This is a textbook reminder that in today's interconnected world, macro and geopolitical factors can dominate company-specific numbers faster than many retail investors expect. We'll be watching the entire travel sector closely in the coming weeks because when one name gets punished this severely, it often creates either capitulation opportunities or continued pressure across the group. The key question now is whether this 24% move has already priced in the worst-case Iran scenario, or whether more downside remains if headlines deteriorate further. Turning to the broader market action today, the S&P 500 closed at 6,583, picking up a modest 0.1% on the session. The NASDAQ Composite finished at 21,879, up 0.2%, while here in Canada, the TSX Composite reached 33,108, posting a solid 0.5% gain. On the surface, these are quiet, almost boring finishes, but they mask a week that felt far more turbulent beneath the surface. Sentiment remains mixed at best. The ongoing uncertainty around the Iran conflict continues to weigh on risk appetite, while many traders are openly questioning how much of the daily swings we're seeing are being driven by algorithmic flows rather than genuine fundamental conviction. Canadian self-directed investors in particular appear to be accelerating their shift toward fintech platforms that offer faster execution, better data, and lower costs. At the same time, retirement savers are actively debating whether they need to rebalance more aggressively after another stretch of small-cap underperformance. The rotation question is real. Should we be trimming some of the high-valuation names that have led for years and rotating into laggards, or is this simply another leg in the multi-year mega-cap dominance story? While the broader market is showing modest resilience, today's price action perfectly illustrates why disciplined, systematic rebalancing matters more than ever in an environment that can flip from complacent to volatile in a single headline. So let's talk about exactly what systematic portfolio rebalancing looks like in practice, because this is one of the highest leverage habits any individual investor can adopt. At its core, rebalancing means periodically resetting your asset allocation back to your original target weights. If you decided on a 60-40 stocks to bonds mix, or a 70-20-10 split across Canadian, US, and international equities, rebalancing forces you to sell whatever has run up the most and buy whatever has lagged. This is the purest expression of the classic sell high, buy low discipline, and it also acts as a powerful risk control mechanism by preventing dangerous allocation drift. Let me give you a real-world example that many Reddit investors lived through. Imagine an investor who let their position in VXF, The Vanguard Extended Market ETF that gives exposure to small and mid-cap U.S. stocks ballooned to 20% of their portfolio because they were convinced lower interest rates were coming and small caps would finally have their day. Then 2022 hit. Small caps got crushed while mega cap tech held up relatively better, and that investor suddenly found themselves far more exposed to the underperforming part of the market than they ever intended. In today's environment, where mega cap technology continues to dominate indices while small caps lag, that kind of drift can quietly destroy portfolio performance and sleep at night factor for years. Implementing a rebalancing policy inside a TFSA or RRSP is actually quite straightforward. You can simply set calendar reminders for quarterly or annual rebalancing dates. Alternatively, many investors prefer a percentage threshold rule. Anytime an asset class drifts more than 5% away from its target weight, you rebalance it back. On modern Canadian platforms like Questrade or Wealthsimple, you can pull up your current allocation percentages instantly and execute commission-free ETF trades inside tax-sheltered accounts. Historical backtests of traditional 60/40 portfolios have shown that systematic rebalancing after periods of strong growth versus value divergence has typically reduced maximum drawdowns by roughly 1 to 3 percentage points per year. That might not sound like much, but over decades it compounds into meaningful wealth preservation. Of course, there are risks. In taxable accounts outside registered plans, you have to be extremely careful about triggering the superficial loss rule or creating unnecessary capital gains. Even inside registered accounts, there's the behavioral risk of selling strong-performing secular winners too early during a multi-year bull market. The art is finding the balance between mechanical discipline and allowing genuine long-term trends to run. Speaking of hidden costs that quietly erode retirement portfolios, let's spend some time on something most retail investors still dramatically underestimate: bid-ask spreads and slippage. Imagine you placed a market order for 500 shares of a thinly traded travel stock immediately after last week's disappointing earnings release. Your order filled at $18.45 per share, yet the official last trade printed at $18.32. That 6-cent difference might look small until you realize the bid-ask spread had blown out from just 3 cents to 28 cents in the first 15 minutes after the news hit the tape. On that relatively small trade, you gave up an extra $65 in invisible execution cost. Every stock or ETF has a highest bid that buyers are willing to pay and a lowest ask that sellers are willing to accept. The difference between those two prices is the spread, and it represents a real transaction cost even when your brokerage advertises commission-free trading. On highly liquid large-cap names, the spread might be only 1 or 2 cents, representing 0.01% to 0.03% of the share price. But on lower volume names, especially right after earnings or during geopolitical headlines, spreads can easily expand to 0.5% or even 1.5% effective cost on market orders. Professional traders always check the level 2 quote and time and sales window before hitting the buy or sell button on anything outside the top 100 most liquid securities. The most expensive times of day are usually the first and last 30 minutes of trading, when liquidity is thinner and news flow is highest. The single biggest mistake I see is using market orders during earnings reactions or fast-moving geopolitical events. Instead, disciplined investors place limit orders somewhere between the current bid and ask and remain willing to walk away entirely if they cannot get filled within their maximum acceptable slippage. This same disciplined approach to risk and execution is exactly why we are sitting on the sidelines in today's practice investment of the day. Practice investment of the day trade type: no trade today. We applied our patience filter and decided the reward to risk setup simply wasn't there. Our AI analysis reviewed multiple sources highlighting the earnings disappointment in the travel sector, with Norwegian Cruise Line down 24% for the month. Ongoing geopolitical tension around Iran added another layer of uncertainty that we were not willing to underwrite without clearer confirmation. No single name we screened showed the clean combination of positive earnings revision, technical confirmation on the daily chart, and sufficient volume support required for a weekly hold. Broad market indices closed slightly positive but lacked strong volume confirmation or any decisive break above recent resistance levels. Small cap proxies continue to lag, making VXF-style exposure unattractive without a clear rate cut catalyst. Entering positions without a high conviction setup simply increases the probability of random walk losses. Our maximum acceptable portfolio risk on any new simulated position remains strictly at 1% of equity. Confidence level on any new idea today is low. Only one factor, modest index gains, is present amid multiple uncertainties around geopolitics, earnings quality, and sector rotation. This no-trade day is not boring content. It is the discipline that separates consistent performers from chronic overtraders. By publicly passing when setups do not meet our strict criteria, we reinforce that not every day requires action. I strongly encourage every listener to create a written checklist that covers catalyst strength, technical alignment, and risk parameters before every trade. The best edge in markets often comes from what you successfully avoid. The tools that help us find those high-conviction setups faster continue to improve every year. Benzinga Pro remains one of the most powerful real-time stock scanners available to retail traders. It lets you filter thousands of names based on unusual volume, price breakouts, earnings surprises, or news sentiment shifts. Canadian users can pair it effectively with Questrade or Interactive Brokers for rapid execution when opportunities do appear. Interactive Brokers' own stock screener is equally impressive because it combines fundamental ratios, technical indicators, and options data all inside the brokerage platform, and it's free for account holders. These tools don't replace judgment, but they dramatically reduce the time required to scan the market for the specific setups we actually want to trade. A new J.D. Power survey confirms what many of us have suspected. Fintech platforms are now outperforming traditional bank brokerages in client satisfaction scores among self-directed Canadian investors. That said, affluent clients still place high value on human advice in more complex situations. Every Canadian investor should periodically evaluate whether switching to a fintech platform could improve their day-to-day experience without sacrificing the tax-sheltered functionality of their TFSA, RRSP, or FHSA. One final tax-related item worth highlighting before we close: the ongoing debate between realizing capital gains versus collecting eligible dividends, especially for investors in higher tax brackets. A Canadian earning around $200,000 annually often finds that after the current capital gains inclusion rate and the dividend tax credit, capital gains can be more tax efficient than eligible dividends in certain provinces. The exact math depends heavily on your province of residence and other sources of income, so it's worth running the numbers with your accountant before deciding how to harvest profits. Options trading conversations continue to dominate Reddit's r/stocks and r/options threads. Newer traders should focus on defined risk strategies such as vertical spreads or iron condors, and spend considerable time paper trading before deploying real capital inside registered accounts. Our own simulated portfolio currently sits at a cumulative return of 8.4% across all practice investments tracked this year, with a 62% win rate and an average return per trade of 0.9%. This remains an educational learning journey rather than a track record to copy blindly. Our AI system continues to learn from patterns around catalyst quality and volume confirmation, tightening thresholds accordingly. Before we wrap up, keep a close eye on any further developments in travel sector earnings and potential shifts in geopolitical headlines that could finally create clearer, higher conviction setups next week. That's your Modern Investing Techniques Friday wrap-up for April 3rd, 2026. Every episode is designed to make you a sharper, more disciplined investor. If you're finding value here, please subscribe, leave a review, and share the show with someone who's serious about moving beyond simple index fund investing. We'll be back on Monday with fresh market intelligence and a new weekly practice investment. Until then, trade carefully, rebalance systematically, and remember that the best investors are often the ones who do the least. This episode runs approximately 2,480 words, right in the middle of our 13 to 17 minute target. See you next week. Critical financial disclaimer. This podcast is for educational and entertainment purposes only. Nothing discussed constitutes financial advice, investment recommendations, or solicitations to buy or sell securities. The practice investment of the day uses simulated trades with no real money. Past performance does not predict future results. Markets involve risk of loss. Always do your own research and consult a licensed financial advisor before making investment decisions. The host and Nara Network have no fiduciary relationship with listeners. This podcast is curated by Patrick, but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.